On April 28, 2026, the world is watching oil prices surge to levels not seen in years, driven by a perfect storm of geopolitical turmoil and severe supply chain disruptions. The headlines are everywhere, and the impact is being felt from Wall Street to small towns across the globe. The price of oil is more than just a number on a screen. It's a powerful signal of global stability, a barometer for economic health, and a direct influence on the cost of living for billions. When oil prices spike, it ripples through every sector, affecting transportation, manufacturing, and even the price of groceries. Tensions between the US and Iran have escalated dramatically, causing real disruptions in the world's most critical oil artery, the Strait of Hormuz. This narrow passage is responsible for nearly a third of global oil shipments, and any instability here sends shockwaves through international markets. In response, Citigroup has sharply raised its oil price forecasts, warning investors and governments alike that risks are mounting, and a quick resolution is unlikely. Their analysts now predict sustained volatility, with prices potentially reaching new highs if the crisis deepens. This sudden shift forces governments, businesses, and everyday consumers to brace for higher energy costs and greater uncertainty. Families are already feeling the pinch at the pump, while small businesses struggle to manage rising expenses. Policymakers are scrambling to find solutions as the crisis unfolds. In this video, we'll break down the key factors behind the surge, the US-Iran breakdown, the Strait of Hormuz crisis, and Citigroup's scenarios for the year ahead. We'll also explore what these developments could mean for the global economy and your daily life. Understanding these dynamics is crucial because oil's story is always about power, conflict, and global interconnectedness. As we navigate this turbulent period, staying informed is more important than ever. The spike in oil prices starts with the collapse of US-Iran nuclear negotiations. Hopes for a deal and a return of Iranian oil to the market have vanished, replaced by distrust and escalating rhetoric. Without a deal, millions of barrels of Iranian oil remain locked out, tightening the global market and raising the risk premium. Iran, now more isolated, may choose disruption over cooperation, especially with sanctions relief off the table. The Middle East's risk calculus has shifted, and the world faces a much tighter oil market than anticipated. Traders are pricing in the increased likelihood of conflict, adding dollars to every barrel. The failure of diplomacy has closed the door on stability and opened one to volatility. The effects of this breakdown are only beginning to ripple through the global economy. The Strait of Hormuz, often called the world's most vital oil choke point, is now at the center of a growing crisis that threatens global energy security. Every day nearly a fifth of the world's oil supply passes through these narrow waters, making it a lifeline for economies across the globe. Recent US-Iran tensions have escalated dramatically, leading to real disruptions, military threats, harassment of commercial shipping, and the ever-present risk of mines lurking beneath the surface. The region has become a chessboard for military maneuvers, with each side testing the other's resolve. These disruptions have already removed hundreds of millions of barrels from the market, creating a historic supply shock that ripples through every continent. The sudden drop in available oil has left refineries scrambling and importers anxious about future deliveries. Citigroup warns that if the crisis drags on, total losses could reach a staggering 1.3 billion barrels, forcing nations to dip into emergency stockpiles at an alarming rate. Governments and analysts are watching inventory levels fall, knowing that reserves can only last so long. Iran's control over the strait gives it powerful leverage over the world's energy supply, and with diplomatic efforts stalled, the temptation to use this leverage grows stronger by the day. The threat of further escalation looms large. The trouble here isn't random, it's a direct result of unresolved political conflict and deep-seated rivalries that have simmered for decades. Each new incident is a reminder of how fragile peace in the region truly is. The world is reminded that energy flows depend on regional stability, And any disruption here sends shockwaves through global supply chains, affecting everything from fuel prices to food costs. As the strait remains impaired, global inventories shrink, and prices climb, putting pressure on businesses and consumers alike. The uncertainty is fueling volatility in markets everywhere. The stakes for the global economy have rarely been higher, as leaders and markets brace for what could come next in this critical maritime corridor. Citigroup has dramatically overhauled its oil price forecasts, reflecting the new reality of prolonged disruption in global energy markets. This shift comes as supply chains remain strained and geopolitical tensions continue to escalate, making previous predictions obsolete almost overnight. Their headline is striking: Brent crude could surge to $120 per barrel in the near term, a level not seen in years. Citi has also raised its quarterly averages for oil prices across 2026, signaling that elevated prices may persist far longer than many had anticipated. The second quarter is now forecast at $110, the third at $95, and even the fourth quarter is up to $80. These numbers represent a significant upward revision, reflecting both immediate shocks and longer-term structural changes in the market. Citi's scenario-based approach highlights that oil's future depends on political and military developments, not just market forces. The interplay between global conflicts, sanctions, and shifting alliances is now a central factor in price determination. The bank urges investors to add near-term crude exposure, betting on further price spikes. For those in the market, this is a rare opportunity to capitalize on volatility, but it comes with heightened risk and uncertainty. For everyone else, it's a warning. The era of stable oil prices is over. Households and businesses alike must brace for higher costs at the pump and on their energy bills, with ripple effects likely to be felt across the entire economy. The market is entering a period defined by volatility and geopolitical risk. Sudden price swings and unpredictable events are set to become the new normal, challenging even the most seasoned investors and policymakers. Citi's dramatic revision signals a fundamental shift in the economic landscape. The bank's new outlook is a wake-up call for industries and governments to rethink their strategies in a world where energy security is no longer guaranteed. The world must prepare for a more expensive and uncertain energy future, where adaptability and resilience will be key to navigating the challenges ahead. Citigroup's base case, now a 50% probability, assumes Strait of Hormuz disruptions last through May. This extra month means millions of barrels won't reach the market, accelerating the drawdown of global inventories. By July, inventories could hit their lowest levels in over a decade, leaving the market dangerously exposed to further shocks. Oil prices are forecast to average $110 in Q2 and $95 in Q3, driving up gasoline costs and business expenses during peak summer demand. This scenario threatens global growth, fuels inflation, and forces central banks to keep monetary policy tight. Even in the most likely outcome, the world faces a tense, expensive summer. The fragility of the energy system has never been clearer. Citi's bull case, with a 30% probability, envisions Strait disruptions lasting through June. In this scenario, Brent crude could spike to $150 per barrel, with quarterly averages at $130 and $100 into year's end. Such prices would trigger recessions in oil-importing countries and widespread economic pain. Consumers would face record fuel costs, businesses would see soaring expenses, and inflation would surge. The risk is real. A 1 in 3 chance of a prolonged crisis with global consequences. The outcome hinges on decisions in Washington and Tehran, and the ability to secure the world's most important waterway. The bull case is a stark warning of how quickly regional conflict can spark a global economic crisis. Citi's Super Bull scenario, a true worst case, imagines not just shipping disruptions but destruction of key energy infrastructure. Oil prices could soar to $160–180 per barrel, unleashing catastrophic economic consequences. Demand destruction would be unavoidable. With a global recession, all but certain, hyperinflation in energy and transportation would make basic goods unaffordable, especially in vulnerable nations. Even developed economies would face job losses, business failures, and a sharp decline in living standards. This scenario could reshape geopolitics and force an accelerated shift away from fossil fuels. While unlikely, its inclusion is a sobering reminder of systemic vulnerability. The world's dependence on a single volatile region is a risk we can't ignore. Oil price spikes aren't just headlines, they hit consumers and businesses directly. Higher crude prices mean more expensive gasoline, shrinking household budgets and raising costs for everything from groceries to travel. For businesses, especially in transportation and manufacturing, rising oil costs squeeze profits and drive up prices for customers. These pressures ripple through the economy, fueling inflation and slowing growth. Governments and central banks watch nervously, knowing sustained high prices can destabilize economies. Oil-importing nations face worsening trade balances, while even producers aren't immune to global slowdowns. The stability of oil markets is a pillar of economic prosperity. When that pillar shakes, everyone feels the impact. The surge in oil prices has shattered market complacency and exposed deep vulnerabilities. Citigroup's forecast, $120 oil, historic inventory lows, and scenarios up to $180 underscore the risks ahead. The most likely outcome still involves prolonged disruption and expensive energy. The market's calm may not last if the crisis deepens and supply losses mount. This is a reminder of energy's central role in global affairs and the need for resilience. The future of oil prices will be decided in the Middle East, not on trading floors. As the world watches, we must prepare for volatility and accelerate efforts to build a more resilient, diversified energy system.